Now, as we go to the U.S. data, I think it's important to look at, some of the things that have come out over the last couple of days, especially when we're looking at leading indicators. And obviously the leading index came out, and just to give you an idea of where it was, last month it was revised down from negative 0.8 to negative 0.9. It was expected to come in November at negative 0.5. Instead, it came in at negative 1%. So again, you're seeing that slow grind down, and it's not. And this is what we've been saying. It's not like the leading index is going from negative 0.5 to negative 7%. It's not. It's gradual at first, but when you look at November and now when you fast forward to December, things don't look great. When you look at new orders, new export orders, all of the internals of the regional Fed data, the PMI data, all of those things point to more issues. But then when you look at initial jobless claims, it's below estimates. When you look at continuing claims, it's right on the nose. But that's where we start to see some of these shifts, especially when you start looking at Kansas City. Fed manufacturing was expected to be at -7, came in at -9, which is similar to Philly, which is similar to Empire, where you're seeing that degradation. Prices paid fell, but still expanding. Again, stagflationary. New orders and production fell deeper into contraction. Employment fell to 0, so flat. Work week fell to -3, but the outlook rose. So to +2. So the new orders and production is what we have been talking about and where we see some of the issues. Now, the outlook got a bit better. That's something that personally we would fight. But new orders and production, that is where we're seeing this bigger issue. But the prices paid fell, but the problem is it's still expanding. So you have new orders and production weakening, economic growth going down, but prices paid still elevated and still a problem, which again creates some of those underlying issues, especially when you look at the different pieces of inflation. So core CPI came in at 6. But median CPI is at 7, trim mean CPI at 6.7, and Atlanta Fed sticky CPI at 6.6. All of those show that strength and that movement higher, which again leads to more problems that we see over the next couple of months when you look at core CPI, because there's still that pull up and then that stability at staying at this elevated level, because core CPI are the things that are going to hit hard. And every metric is in the red in November, but it's still in the red in November of 2022. So year over year, things are getting better because of math, because if you think about November of 21, things were pretty terrible. But again, on a metric level, this year, they're slightly better than they were in 21, because in 21, things were worsening. And here we're kind of on this flatlining level. But that's why we talk so much about month over month. We're still seeing an increase in prices, an increase in inflation. It's happening at a much slower pace, which is why we've talked about disinflation. So the rate of change of inflation slowing, leading more towards that stagflationary backdrop. And this kind of shows what we're looking at, where core is going up and there's still a pull that's coming from the flexible side. So flexible CPI rolling over considerably, which makes sense when you look at gasoline, when you look at diesel, when you look at some of the internal components, but it's taking longer to come down. And it's still, when you go back through time on the flexible level, it's at the highs that we had in the early 2000s, in the late 2000s. So when you look at it in 05 and then again in 07, but then the other time that you can get back to this level was in the 1970s. So even with a huge drop in flexible inflation, you're still at the highs. So again, that's going to pull up and really support this core being much stickier, because the setup today is still markedly different than in the 1970s, when both series were rising and falling together. And that's that disconnect that we've talked about, which is why we don't see core falling the same way or sticky falling the same way. And the reason why, when you think about it holistically, sticky inflation is driven a lot by service cost. When you think about the 1970s, there was a lot of manufacturing in the U.S. A lot of that has been exported and has now been, globalization has pulled a lot of that away. So manufacturing ebbs and flows, and there's a big connection between the two. But now the U.S. is a service economy and not a manufacturing economy. Because if you think about it, just as, lessons of this, you go from ag to manufacturing to service. So we all know service cost and service is in a sticky inflationary number, which is why there's that difference. We have progressed on an economic level, but that's going to be an impetus to keep that sticky inflation where it is. And just looking at kind of where we are on a 12-month rolling basis, you get an idea that sticky is flatlining. It's still moving up. But then when you look at flexible and then core flexible, things are coming down, but some of the rate of change, especially on the core flexible, is flatlining. And that's where you're going to get this kind of marriage of the two between sticky and flexible, which is going to be very difficult to break, which is why the Fed's going to continue to raise rates, which is why they're going to stay higher for longer to try to bring this back down and to create some of this shift in movements. And cumulative change in financial conditions are actually loosening. So the last thing that they want is some of this to get looser, because that means you're going to get more volatile, more money, the cycle of money, the more the velocity of money. The velocity of money is going to pick up. You're going to get some of these movements, which is inflationary, which is not what they want. So they want to keep financial conditions tighter, which is why they're going to sit elevated. But companies are tapping their revolving credit facilities, and when you think about it, they're starting to get a little bit of panic on the companies, on the corporate side, where you're going to pull down some of your revolving facilities because you're not rolling your debt the same way. The debt to roll is expensive. So what are you going to do? Well, you're going to tap your credit facility. You're going to pay off your debt, and you're going to wait for rates to come down, and you're going to cut CapEx. You're going to cut R&D. You're going to cut labor, and you're going to try to live more within your means. All the while, American consumers will end the year with about $110 billion more in credit card debt than they started with, which would be close to an annual record. And that's the biggest component when you look at some of the spending. And that's going to be a common theme throughout this, where there's a record amount of credit card debt that has been added, and it's not going away. If anything, it's only going to get worse as we progress into next year. And then I always think this chart is a beautiful explanation of new orders versus prices paid. Prices paid bounced in the Empire Manufacturing as new orders came down. That chart right there, that box, is stagflation. That is the definition of stagflation if you have to see one. And that's when we continue to see, and the index updated showed prices paid component moving higher, remaining elevated, and new orders contracting. And if you look at prices paid through history, you're still at the very high end, even after this correction. If going back to 2004, which is, again, more of the impetus to see that stagflation. But wage growth is fading fairly fast in the low wage category, which is a positive for some of the labor cost, but a problem for that stickiness in that sticky inflation and core inflation, because that is not something coming down. So you have low wage earners that are now earning less. You have stickiness in inflation, so the things that they have to buy every day are staying expensive. And then you have the credit cards maxed out. You have the people that would fall on the low wage side. They've already blown through their excess of savings. So now what? And that's only going to weigh further, because they're going to have to rely on credit more and more. With the wage growth is falling in most categories, but starting to kind of flatline here, and you should see some of that stabilizing. And we're going to show some other areas where wages have gone up a bit, and that's where you're going to get kind of this back and forth between some of that labor is deflationary, some of it is staying kind of sticky inflation, but it's going to be based on wage levels, and are you working from home, working in person? A lot comes into what these numbers are actually made up of. And this is when you start looking at just another way of evaluating the financial conditions getting a bit easier. So then when you take that and you look at recent increase in household sector, they're buying more treasuries. Well, even though we think rates are going to continue to go up, so we would not be buyers yet on treasuries, it's still yielding something that is below inflation, but still going to give you some sort of income, and it feels safer than some of the numbers when you look at the market. But that's why when you see some of this snapback, that as the equity comes down, we see some of right now we're in a bull steepener. We think we go into a bear steepener. And when you look at some of those leading indexes, as we've been saying, all of it is screaming early recession. We're late in the cycle, and we're pivoting into this early recessionary late period. And the benefit for us is it's still early. Like, you're looking at this, you've been watching us, we've been talking about it all the way through. Now every warning that we've been giving, it's like, look, this is what's coming, this is how it's going to happen. It's here, and it's happening now in real time. This isn't, it's going to happen next quarter or 2 quarters from now. We're in the thick of it, and it's only going to get worse from this point. CEO expectations point to a slowdown in CapEx, which again speaks back to what we saw with the slowdown in increase in revolvers, pulling those down. You're going to cut CapEx because you're pulling down your revolver, which is cheaper money than what you can get in the market, but you want to make it last. And that's when you're going to start cutting that CapEx. Average reservation wage, or the lowest a U.S. worker is willing to accept a new job, rose to $73,700 in November, highest since tracking began in 2014. So people are still not cheap. And if you think about $73,700, that's a more of a higher end wage, not a low end wage. So you're still seeing that tightness in the market where they're like, look, we know we can't ask for 85 now. There's been layoffs, there's been some slowdowns, but you're seeing some stickiness at these levels. And a lot of that, and if you're the employee and you're looking at this and saying, well, 73,000 is pretty fair given where my costs are. And the employer is like, well, I understand why they're asking for it because I see what the price is, but my CEO, my company is cutting CapEx. It's cutting, what is slated for this, which is why we should start to see hiring freezes, raise freezes, bonus freezes, and that's where you're seeing some of this friction now between that increase in wages and those decrease in wages, battling it out. Then when you look at the Conference Board Consumer Confidence, was expected at 101, came in at 108.3. So now you're kind of bumping along. Present situation slightly better than expected. Again, kind of bumping along. You're still getting lower highs, and as we've said, nothing dies in a straight line. What does the consumer see? Well, gasoline prices have gotten better. Things have improved slightly in terms of things that they can see, touch, and feel. And gasoline is a big weight on that. Now, that doesn't mean that you're seeing a big increase in driving, because you're not. It doesn't mean you're seeing a big increase in spending, because you're still seeing people that are a bit struggling. And again, that's weighing on some of those key pieces. Expectations still very low, but bouncing off the level. The expectations are still at 82.4. You're still seeing what's to come is still going to be tough. It just may not be as bad as initially expected. But as we said, nothing dies in a straight line, so we do expect that to come down as well. But the Conference Board labor differential, so the labor differential index, which is jobs plentiful minus jobs hard to get, unexpectedly increased, signaling confidence in the jobs market. The index has diverged from the headline consumer confidence indicator. And that's, I think, a big piece, because when you start looking at wages, everyone's like, well, it's getting weaker, but not that weak. And it comes down to labor force participation rate. You're seeing some of that slowdown in that differential. And that's where, again, you're seeing some of that stickiness on that wage front, which is what we've been highlighting. So then when you look at U.S. credit and debit card spending, it's now negative. It's negative even in discount and dollar stores. It's already negative in big box, in department stores. So now the last strong period, which is why we've said that if we thought it was going to be October, where you could see the pivot, we thought October retail sales was going to be the start of the decline. It ended up being November, but it's been a perpetual drop since then, which is why we see some of those pressures. And that's why when you look at the conference board confidence, which is at that 108.3, well, people are spending less. That's going to draw that down. So again, we do see both of them moving a bit lower over the coming the coming quarter. U.S. industrial production continues to expand, but annual pace is cooling to 2.5% year on year, and we see that going down further. Business inventories grew by 16.5% year on year in October, still incredibly fast relative to history, and that's where we do see some of that friction when you look at, well, inventories are going up, we can keep moving down production, and that's, again, something that's going to play out more in Q1 than right now. Putting this all together, Empire, Philly surveys, and GDP, you see that there is a natural pull down in where things are right now in terms of where GDP is going, which is why we do see a lot of weakness in Q4. But more importantly, we see the negative, GDP going negative in Q1 of next year by a wider margin than it will be this year. I should say in Q4 this year, which is then you look at retail sales expected to be at -2, came in at -0.2, came in at -0.6. You look at U.S. retail sale, core was supposed to be flat, came in at -0.2. You're seeing, again, that little bit of slowdown, but we see that accelerating given credit, given all these different pieces. And especially when you look at it on a real basis, things are kind of flat. So there's still a lot of room to the downside as people get hit harder with inflation, as they get hit harder with dwindling savings, in their credit card bills that they're carrying month over month continue to expand, which is going to, again, limit even more the spending ratios. So retail sales increased in November by 6.5% year on year, which was the slowest since December 2020, but still fairly strong. So again, there's way more downside that we see coming, especially as that fiscal drag increases, people spend less, which will be a bigger problem. New orders component within Philly index firmly in recessionary territory. Inventory build not expected to be an issue at all, but the index in December outlook has fallen to the lowest worst since April 2009. And that's when we're going to take this and we're going to talk more about it in the next segment to look at some of these leading indicators on why this being just an example of problems that are coming next quarter. This is kind of that leading drive to, which we're going to give more color around, and then layer in a lot of the weakness in the real estate market, which is only going to get worse next quarter as well.